Are you asking the management teams in your portfolio the questions that really matter? Are you able to discern fact from fiction? Find out what legendary investor Rick Rule, the director, president, and chairman of Sprott US Holdings, directly asks all CEOs before he invests. To receive a free copy, simply submit your email below so that you may invest with courage and conviction. Welcome to Proven and Probable. I'm your host, Maurice Jackson, and joining me today is a very respected guest that I've followed for years, David Morgan, the author of a book that every precious metals, hard money advocate, lover of the Constitution must have in their portfolio. David Morgan, thank you for joining us today.
Well, Maurice, thank you for having me.
Sir, I've followed your work for the last 5 years, and I must say you have really put me to the challenge as a U.S. citizen to make me really delve into the Constitution and to learn more and to think critically. You're known as the Silver Guru, but I tell you, you're much more deeper in breadth and depth than that. And I'd like to talk to you today about a number of things that are on my mind. First, beginning with what's going on right now in the economy, specifically the stock market. Would you like to have an opinion on that?
Well, I've got an opinion on almost anything, as you well know, and thank you for the introduction. And yes, the Silver Manifesto is available on Amazon. It's also available as an ebook, which saves you some money. And for those that like audiobooks, and I myself do, it helps me to get better educated in the world we live. It's available as an audiobook now as well. So coming back to the question, the stock market. By any metric that normal analysts would use about the stock market, the general equity market, not a specific stock, is it's overvalued. It's overvalued on an earning basis. It's overvalued on a book to value basis. It's overvalued in any way, basically, that you can look at it. However, the idea about a high stock market or a big number seems to be one of the mainstream press's best means of propaganda to lull the main citizenry almost to sleep, because looking at a high Dow convinces a lot of people that don't really know financial markets or understand how the stock market works that if the industrials are doing well, then the economy must be doing well. And even though perhaps I don't feel like the economy's doing well, or my neighbor or my family doesn't, look at that stock market. Wow, wow, wow. That's sort of the subset that may be going on unconsciously throughout the populace. The truth is that the financial markets or the stock market used to reflect actual physical economic conditions. In other words, if you had a strong industrial base and a good transportation index, I believe in Dow theory, so if you had a strong industrials, strong transportations, utilities were strong, then that was a reflection on a robust economy. In today's market, where almost all markets are manipulated, it is not reflective of the real economy. So people's inner knower, if you will, they can look around and see the devastation in any hometown. And of course, there's pockets of enthusiasm here and there. I'm not saying it's totally dark or totally bleak, but the reality is that the labor participation rate's the lowest it's been in decades. The unemployment rate is far higher than the propaganda press will lead you to believe. So the physical economy is much worse than the stock market would indicate. And I believe this is absolutely, totally, and completely by design. That this is something that the mainstream is well aware of, and that it keeps, again, the people thinking that things, if they're not better personally, that they're going to get better just ahead. So that's a very long comment. I'd appreciate hearing what you think about that, because you could probably add on or make some corrections or some comments on what I've said.
Absolutely. As you know, for the listeners there, I'm a staunch advocate for hard money, and I'm a staunch advocate for the Constitution. And what I notice as well, as you are well aware of, David, is this, that we have a lot of sophisms in the press. And a sophism is a lie that's been told over and over again until you accept it as truth. You alluded to the stock market and how the numbers are high. I think today the Dow's were roughly, it's over 17,300 as we speak. And the price of gold probably is, what, 1,000 60 as we speak. And so there's a bifurcation if you look at the numbers, and people in masses like something that is green, something that is going up, and something that has momentum, as they may be persuaded to believe that there is momentum there. And I like to always make the distinction between fool's gold, which is called chalcopyrite, and real gold. And if you really knew the truth, the deception that you have with the stock market is you have what's called the Dow divisor. And I'd encourage anyone to look this up. You take companies that comprise the Dow and you have a Dow divisor. If you took away the Dow divisor, you'd have a very, very close relationship with the price of gold. I wonder why they do that. I have no formal or technical reason or academic reason of knowing why they would put in a Dow divisor other than to create momentum in something that really isn't there. If you're not familiar with the Dow divisor, what it is essentially you're taking 30 companies that comprise the Dow, and you divide that by 0.1496, and it's a long number, but just round it up there. And it takes the price of those 30 Dows to 17,000. But the reality is if you took away that number, it would not be there. The numbers reflecting the stock market would be closer to 2,000, probably maybe upper 2000. So it's a much closer relationship to the price of gold. And I think that's part of the manipulation that you have is the Federal Reserve doesn't want you to go into derivatives of money, which is currency, which is what you use to purchase stocks, because you can't use gold or silver to purchase stocks. And I just always found that interesting, but I never could get an answer in the world of academia when I was there on why we had the Dow divisor. And I'm a business management graduate, and I never could get an answer over the years of my study. So I was just curious.
Let me add on to that. First of all, that's great to get that, out into the table. Excuse me, that's great to get that out on the table because now people want to know what it is. And I agree with you, Maurice. I think it's part of the scheme of things. Now, I don't want to make everything that we look at as conspiracy, and I'm not saying that it is, but I think it's odd that if you didn't have the Dow divisor, that it would be a different number. What I do know is that it's a lot easier to manipulate 30 stocks than 500. The S&P 500 is a little bit more reflective of the real economic conditions than the Dow is. The other thing about the Dow that most people don't know, unless they know a little bit about the stock market, is that those companies rotate. If you have a company that's doing poorly, it's taken out and it's replaced by a stronger company. And this has been going on for a very, very long time. So if you go back to when the Dow started, I think there was like one or two companies that still make up the Dow from the original formation of the Dow Jones Industrials. And this is a key concept because it's not a true measure. It's like being able to change the rules in the middle of a soccer game for an analogy. You're not looking at the same game by the fourth quarter that you started with because they keep changing the rules. And this is something, again, that I think really focuses in this sort of man behind the curtain kind of an analogy, this metaphor that the Wizard of Oz is, that it's the great and powerful Oz, and look at the Dow and look at the numbers and look at how great it is and yada, yada, yada. And you pull back the curtain and you see this little old man pulling a bunch of levers and causing this idea that things are really, really good when in reality it's just anything but. So thank you for that. It's something that I've never been asked before. I don't really have an answer, but my ideas follow yours.
Well, and I'm glad you brought that up as well, the reference to the stocks changing, because I've had some debates with those that are professed Keynesians, and the rebuttal to me was, well, look at the Dow back in 1971 and look at the price of gold. And I share with them, are you aware, before we get into this debate, let's pull up the companies that comprised the Dow in 1971. And although it's not even Christmas, you do hear silent night carols because they're not aware, like, whoa, I didn't take that in consideration before I tried to rebut you. And let's see if those companies are still there. And you made the point earlier, they're not there. And so the target is moving, and that allows you to make the case against gold when you're debating against me until you realize, wait a minute, I was not aware of this factual information here.
Well, another way to look at gold, is first of all, my belief is that gold is a wealth preserver. It's a crisis hedge more than being an inflation or deflation hedge. It's sort of a vote against government manipulated currencies. And in the long run, it does preserve wealth. I mean, what no one really talks about from the foundation of the Federal Reserve is that, let's say you had a very wealthy uncle, Maurice, and back in 1913, your uncle gave you $1 million in currency. And today, in 2016, you would still have $1 million of currency. And believe me, $1 million in currency in 2013 was a pretty rare event. But let's say that you had the choice. Of course, this would be projecting in the future, but this is just a thought experiment and it makes a point.
Mm-hmm.
That you had a choice with your rich uncle. Instead of taking $1 million in currency, you took $1 million in gold coins. Now, where would you be in 2016? Well, in one case, you'd have $1 million. That currency would be $1 million. But if you took it in gold, gold in 1913 was roughly $20 an ounce, and today it's 1,000 an ounce. So if you divide 20 into 1,000, you will come out with the number of 50. So you would have the equivalent of $50 million instead of $1 million. And this is something that almost anybody can grasp the concept of. They'll tell you that, gold does this and it doesn't go up and it doesn't this, it doesn't that. Well, let's look at this over roughly a 100-year period. What did it do?
Exactly. I give a smaller case analogy. I say the year's 1971 is August 14th, and you have two kitchen drawers. You have $35 or 35 Federal Reserve notes, as I usually say, and you put them in drawer number one. In drawer number two, you put an ounce of gold. And today you open those up. What will the 35 Federal Reserve notes purchase you? The answer is a lot less than what they could in 1971. And now look at what that ounce of gold will purchase you. And that's, to me, is the best, clear, definitive case, as you just mentioned one as well, of which one is a wise and prudent and solid investment. David, I'd like to ask you a question here. I know that you're a strong advocate of precious metals, but I want to hone in more on silver. Let's take a look at today. It's December 2015, and I have 15 Federal Reserve notes, and I can put them in drawer number one, and I have 1 ounce of silver, and I can put it into drawer number two. Let's go fast forward a couple of years from now. Where do you think these two will end up in valuation?
Well, history proves that over a longer time frame, in 2 years I'm not sure, but a longer time frame, silver will certainly do better than the Federal Reserve note will. The point about silver that's a little more tricky than gold is that it's a smaller market and it's more volatile. And so you can have these huge moves in silver, and you can have a corresponding move in gold that's maybe 1/3 as big. I'll digress just really quickly. If you go back to the last bull market, and what I want to emphasize to your listeners, Maurice, and that is that 90% of the move comes in the last 10% of the time. If you look at the silver and gold bull markets starting in the 1970s, I actually look at the bull market starting for silver at least in 1965, because that's when it was basically demonetized. You could go till 1968 and turn in a silver certificate and actually obtain silver bullion for it. But that was at the monetary price of $1.29 per ounce for silver. And if you went all the way to January 1979, so this is like 15 years or so, the price of silver had gone from the $1.29 monetary standard fixed price to about $6. But in that last year, from January 79 to January 1980, silver went from $6 to $50. So you had an over 800% increase in the last 10% of the time. That's how these markets move. Gold went from roughly the $300 level up to $800, so not quite a 300% move. So you had about a 900% move, or 800 as I said, and less than 300. So you had roughly a 3-to-1 ratio where silver outperformed gold by threefold. But that was in, again, a very small time frame, that 1 year that I've selected to talk about. The point I want to make is that all currencies have failed. I think the biggest thing that I've tried to do over the years that I've been on the internet and done interviews like yours is to get people to think critically. And the main premise is people love guarantees. If you had that one horse you could bet on and, make a small fortune at the track or that football game or whatever, and I'm not advocating gambling. What I'm trying to say is that people really like certainty. People strive to make their conditions around them predictable so that they can feel secure. And the same holds true in the financial markets. And you can't, in my business, guarantee anything. You're not allowed to. But I can almost guarantee this. Every fiat currency that's ever been recorded during man's history has failed. And so the idea is, why won't the dollar fail as the reserve currency of the world? And of course, we both know that it is failing. From the example I gave in the 1913 to present day, an ounce of gold hasn't changed. Its mass has remained constant throughout the universe for that 103 years or so that we talked about. What's changed is the amount of paper it takes to purchase that same fixed mass of gold. That's what's changed, which is a depreciation of the currency. So in the long term, gold's mass doesn't change. The value of gold changes in the currency. And so this is the big problem, is where exactly is the currency going to fail, or how do you measure its failure? It's worth about 4 cents from where it was in 1913, and yet no one stops to really think about that, other than academics like us, the Austrian school, a few clear thinkers. And this is what I want. I want the critical thinking for people to wake up and say, geez, if it's gone from 100 cents to 4 cents in 103 years, where's it going to be 103 years from now? Will it exist? And the answer is no, it won't. It won't exist in this form. There'll probably be some currency. It's hard to say. What I want to say is very simple. You've got to think about this. You've got to think about it critically, because it's probably the most important topic that intelligent beings can think about. Because no matter what your religious beliefs, no matter what your ethnic background, no matter what your sexual orientation, it doesn't matter. What matters is money transcends everything, and it's critical. And no one really understands what money is. They think currency is money, and as we've alluded to in this discussion, is currency is something far different than money.
And if you would, please do share with everyone, what is the definition of a dollar?
Well, it's 371.25 grains of 0.999 fine silver. That's the definition of a dollar. It's a weight. So people don't know that. They don't understand it. And even what I just said will probably confuse a lot of people, but that is at law, even today, the definition of a dollar. It's a weight in silver. It's a constant. And this is where the country was actually founded. That's in the book, the Silver Manifesto. We actually go into that idea rather in depth, so that people can kind of grasp on to what the thinking was in the founding or the beginning of the nation, because the forefathers knew the devastation of a paper currency, because they had experienced it with the Continental before the Constitution was formed and the whole system really was set up. So this is something that's critically important, but yet again glossed over, and you'll never learn about that in the mainstream school system.
Agreed. And if you're wondering what that source is, that is the 1792 Coin Act for the definition of a dollar. Please do take a look and educate yourself on the definition of a dollar. You mentioned the last bull market. I don't know the exact statistics, but was it 8% of the world population owned precious metals versus today, I think it's 0.3. Is that correct?
Well, no one knows for sure. So, you're going to make an educated guess from some of the better sources that I know of. Really, the idea back in that bull market was about 1, maybe 2% at the most owned it. Now, I've heard numbers as high as what you threw out there, and that might have been true in a specific region like the United States, which I really doubt it was that high. But on a global basis, no, it's more like perhaps 1%.
Okay.
And the 0.3, I think it's maybe higher than that. But I think the idea is what we need to stress. So let me do that. The idea is that if you want to hedge an outcome, such as a financial collapse where the dollar is destroyed, or there's a bank run or bank closure, or a brokerage house goes under, all the things that we've already experienced. I'm not being a doomer. I'm just saying, hey, it's what's already taken place in 2008, what happened in London with BlackRock, what's happened with Lehman Brothers. If more of that were to take place, so I'm talking about a fact, but I'm projecting it into the future, and you wanted to protect yourself with precious metals, and you decided the prudent amount was 10%, which is what I recommend to most people, but 20% is really better, but let's just use the 10%. If you had the net worth of everybody that has a net worth, which isn't that many people these days, and they put 10% of it into the precious metals, you couldn't put a paper price on these markets because they're so precious. There's so little of it relative to the amount of currency that's sloshing around in these markets. So that's the point I want to make. It's better to get it before you need it than to try to get it after these markets go ballistic, which I believe strongly they will. I really think, even at these low prices today, that when that change in consciousness happens, that catalyst that takes place, whatever that is, that there is the run to gold. And believe me, there's no fever like gold fever. As I said before, money transcends everything. So when people are scared that their money is not going to purchase them what they need tomorrow, and they decide that they are going to buy something valuable with it, be it a jar of peanut butter or an ounce of silver, there's going to be a rush into the precious metals like we've never seen in all of recorded history. That's what I truly believe, and I think that's not that far from us. I think we're probably going to witness something like that in the next few years.